with Standfast Asset Management. I'm the president of that company. And we're going live on Facebook today to talk about investing. And I kind of want to do this a few times, so this will not be the first video that you will see. The reason we're doing it is that people often ask, they say to me, Scott, we know you from doing the historical presentations about the submarine attack and some of the civil rights activity. We know you from the newspaper columns, and I write newspaper columns in a couple of different newspapers, and I contribute to some of the local magazines on occasion as well. And most recently, the radio show, which kind of has gotten a lot of attention, and people will say, geez, we know you from all those things, but we don't know what you do in terms of being an asset manager at Standfast. So we want to share that, share a little bit about the Standfast system, and hopefully you'll learn something. So I want to start out today with kind of a basic concept. The basic concept is, what is an investment? If you ever took a corporate finance class, they told you that an investment is something that you invest in for a long period of time. And the kind of definition that everybody talks about is from this book. It's written by a guy named Benjamin Graham. It's called The Intelligent Investor. It was written in 1949. It's still one of the best books on investing ever written. And I would urge you, if you're interested, to pick up a copy and read it, because it's great. Benjamin Graham is sort of the grandfather of financial analysis and investing. And he taught a number of famous investors, and the guy everybody mentions is Warren Buffett. Warren Buffett was a student of Benjamin Graham's at Columbia University as a young man. He went and got his MBA there. And the story he likes to tell, that Buffett likes to tell, is that he sent Graham a letter. And that in the letter he starts off by saying, I thought you were dead. And in life, I'd like to come and be a student. And Benjamin Graham helped get Warren Buffett into business school at Columbia. And it's interesting, Buffett had been rejected by Harvard. And so Benjamin Graham was able to get him into Columbia. Buffett studied under Graham at Columbia and learned a lot from Graham. So in any event, in this book, The Intelligent Investor, Graham talks about what is an investment. I'm going to read it to you. An investment operation, he says, is one which, upon thorough analysis, promises safety of principal and an adequate return. Now, that sounds sort of boring, and it is. Investing is a long-term proposition, and it is generally a boring activity. It's typically months, sometimes years, of dull, interrupted by brief moments of either intense panic or intense exuberance. And those are the times that really try you. Now back to business school. In business school, they would have taught you that the value of an investment is what it pays you. And that's generally true. Now I had an argument with a corporate finance professor when I was in grad school, and I kind of vividly remember this. The guy stood in front of the classroom. He says, what are we waiting for? For Microsoft to disgorge a giant dividend? And he was saying, Microsoft wasn't an investment, didn't have value because it didn't pay a dividend. I was in class, sort of raised my hand and shouted out, and I was somewhat more confrontational at that point in my life. And I said, yeah, that's exactly what we're waiting for. And I felt somewhat vindicated many years later when Microsoft did, in fact, disgorge a giant dividend. Now, the concept that investment is worth what it pays you, you can value almost anything. If you have a pizzeria or a dry cleaner or a stud horse or an apartment complex or a strip mall, tell me how much income you take in every year, and there's a formula, and I'll tell you what your business is worth. You can do that with any business in America. Now there's some modifiers, other factors, but the basic core of your business can be determined based on the revenues. So when I go looking for investments to make, one of the things I always like to look at is the revenue. The other thing is the dividend. What I ideally like is to find a company where the dividend and the sales are both rising, have been rising for some time, and based on my analysis, are likely to continue to rise. And I think if you can find that, and you can find it at a reasonable price, you're likely to be successful. Now, the reason we're investing in stocks in the first place is we want to make a better rate of return than we can on guaranteed investments. And typically, stocks have outperformed guaranteed investments. Typically, the stock market has provided the best return of any financial asset. And most people are investing with a goal towards accumulating a pile of money so they can retire comfortably. That's the number one reason. And what I would say is that the investment that's most likely to get you there is the stock market. Now, we invest in companies typically that pay a dividend, and one of the reasons is that even back in 1949, when Benjamin Graham wrote this book, and in the 30s when he wrote other books with a guy named Dodd, there were a fair amount of shenanigans on Wall Street. People would make stuff up, make up earnings, make up revenue. The thing is, you can lie about your balance sheet, but you can't lie about a dividend, because a dividend's cash, and you got to have the cash to pay it. And so you have a certain level of safety with companies that pay a dividend that you may not have with companies that do not. Additionally, kind of put together a kind of simplistic look at dividend stocks versus non-dividend stocks. Now, suppose I have a company that I want to buy that pays a 2% dividend. And what that means is that if I invest $1,000 into that company, I will receive $20 in cash dividends annually. And again, you can't make that up. But let's just say 2%. And 2% is not an unreasonable number. Intel pays 2%. Intel's a pretty big company, one of the largest chip manufacturers in the world. They actually pay 2.25%. So 2% is not out of the realm of possibility. You get a 2% dividend. Now, let's just say that I own a stock that pays a 2% dividend, and the market goes up 10%. And not only does the market go up 10%, but my stock goes up 10%. So I've had a 10% increase in value plus a dividend. So what have I earned? 10% increase in value plus a 2% dividend, or a total of 12%. Now, the market doesn't always go up, sometimes it goes down. So let's say that instead of going up 10%, our fictional stock in a fictional stock market goes down 10%. That's not what we want, but it happens. So when the stock goes down 10%, we also have a 2% dividend. So negative 10 plus 2 is 8. So we have a negative 8% return. Actually, it should be a negative sign there. So we have a negative 8% return in a down 10% market. And the reason is a dividend. So in the up market it was 12, in the down market it was 8. The market did the same in both scenarios, but our returns were better in both cases because of the dividends that we were receiving. There's a number of stocks that pay dividends. Some of the biggest companies in the United States, in the world. The one thing I would caution, sometimes people get sold on the concept of dividend investing, and they go out and they look for the biggest dividend they can find. Don't do that. Again, what you're looking for is a dividend that increases, not necessarily one that starts out very rich. And one of the problems with a dividend that starts out very rich is sometimes they don't last. And again, we want that dividend to rise over time. Dividends and sales go up, relative value of the company goes up, will fluctuate around its true value based on how people feel about the markets. You can't stop that. But as long as the earnings and the dividends are increasing, the value of the company will increase. I don't think in this version of the video that I talked about as many stocks, but I know I talked about Intel, and let me give a shout out to my personal favorite company of all time, Coca-Cola, and to my favorite company of the recent past, Microsoft. So that in doing that, I need to disclaim that any of the stocks I mentioned during this presentation, that one, I own them personally. My family owns them. clients of Standfast own them. And we may, at Standfast, buy or sell those stocks, either for myself or my family or for our clients, without giving any notice at any time in the foreseeable future. And I believe that's the disclaimer that's required. If you'd like to know kind of what we own, what we think you should be buying, I'm pretty happy to share that information. I like talking about the stock market. I don't do it a lot, but I do like talking about it when I get the opportunity. So thanks for watching, and we'll see you next week with another installment on our investment discussion.